very important information coming to us on Friday. We have one more non-farm payroll after this, before the November 7th meeting. So yes, two key data points, and reiterated by the Fed that these are important ones to watch.
Vishal, talking about things to watch, when you look at indicators like the MOVE index, is that understating potential volatility to come when you consider headlines from the Middle East, such as the one I was just talking about, given the East Coast port strikes which are looming, Hurricane Helene as well? It just feels like there are multiple major supply-side shocks that are waiting in the wings.
Absolutely agree. And that's what we've been talking with our clients as well, quite a bit, both here as well as globally, that we think that the interest rate volatility and the risk asset price volatility has been suppressed. And part of the reason for that is the September being one of the strongest month for easing after COVID that we've seen. Not only the 50 basis points cut that we saw as the committee wanted to stay ahead, as we heard earlier in the program as well. And then later in the month, we did see China coming out and showing their very strong and clear intent for the stimulus, or the fiscal side stimulus coming in, apart from the monetary side that they've been working through. So you have those countervailing forces that are pushing volatility down, and that's what they are designed to be, to basically suppress the asset price volatility and then effectively maintain that calm in the market. So we think that is underpriced in the market, and that's why I think we are taking a tiny bit of a conservative stance in our portfolios right now. We are overweight risk, but then we have quite a bit of room before we can add more, as valuations are Pollyannishly pricing a very, very soft landing here in the US and globally as well.
Yeah, so potentially pushing down volatility, but also potentially pushing up inflation. If you think there is the risk then, Vishal, that the Fed could underdeliver on the rate cuts that the market seems to be pricing and hoping for, what kind of impact will we see in the market?
So definitely, that's our base case, that the Fed will underdeliver. Mainly, I think that reason, or the background for that, is that we do think that it will be a soft landing. I know that term has been overused quite a bit in the market. I think the definition of soft landing is, this is how a soft landing would look like, where you are seeing labor market rebalance, where you're seeing growth slightly come off the boil that it had gone through 2022 and 2023, and inflation coming lower with balance sheets stronger. So in that scenario, if the economy is resilient enough, you don't need a recessionary kind of cuts coming through. That's what the market is pricing in. So if that does not come to fruition, we do think that there will be a tiny bit more volatility in the risk markets, and that'll be a great time to actually add risk to or credit risk to the portfolios on the fixed income side. So I think even with a conservative stance in the portfolio, that we are overweight, but slightly on the lower end of overweight that we are in the portfolios, we still can earn that good carry in the portfolio. So it gives you that first mandate of fixed income being income. And then it gives you that sort of negative correlation to risk assets, which is your second mandate that fixed income has delivered on. And we do think that the next 2 years it will continue to deliver on as well.